Did you ever feel that being an entrepreneur adds stress to the thought of what retirement will look like? Or maybe you thought a traditional IRA or a regular investment was the only way to build wealth for the future? What if I told you there are options to not only set up your retirement, but save big on taxes while doing so? Well, today we're discussing just that. Hey there, tax warriors. Welcome to JDV Tax. I'm Brian Mustache, enrolled agent and tax strategist. But I call myself a taxtician, a tax tactician leveraging the tax code to the fullest extent. With this segment of Tax Tactics, we're tackling a big one: retirement planning for the self employed. Let's get into it. In my last video, I touched on solo 401ks when discussing putting your spouse on payroll. So I decided to make a full guide to retirement plans for business owners and their benefits for tax savings. First off, let's make it clear. Self employment doesn't mean you're left out in the cold when it comes to retirement planning. In fact, you might have more options than you think. Planning for your retirement can be a little more challenging if you're self employed, but finding tax savings through retirement options doesn't have to be a hassle. You have to look at your financial situation. Now, everyone's financial situation is different. Knowing where you begin and where you want to end up helps you make better choices. Many business owners fail to consider these items earlier in their careers. So ask yourself these questions to understand your money better. One, how much money do I really? People often talk about net worth, which means your assets minus your liabilities. When you figure out your net worth, you look at what you owe and what you own, like a money checkup, for example. Debt is tricky. It's like trying to run fast, but with the wind pushing you back. It takes away from your money growing. Usually, paying off debt is smarter than trying to save because debt costs you more in interest. Not having enough saved or too much debt can really affect when you can retire. Number two, what big things will I need to pay for before I retire? Think about big costs coming up, like paying off your house, saving for college, or even a big family wedding. Don't forget about cars and trips too. Remember, unexpected costs can happen, like doctor's bills, which can be really expensive. Number three, what will my cost be when I retire? Do you plan to have your house paid off? Or you still have payments? Maybe you might move to a smaller place, or maybe you might pay rent. Knowing what your costs are when you actually retire will help you know what to plan for instead of going in blind. After you know your starting point, you may say, so what can I do to plan for retirement? And what were those big tax savings? A lot, from SEP IRAs to solo 401ks. You've got some powerful tools at your disposal. These aren't just your average savings accounts, they're turbocharged retirement vehicles that can help you stash away a significant nest egg, all while helping save in taxes. Take a look at these retirement plan options. Number one, simplified employee pension IRA, SEP IRA or SEP IRA. This is likely to be the best option for many, especially if you're a one person operation. With a SEP IRA, you can stock away up to 25% of your net earnings. There's a limit of $69,000 for a 2024 contribution. The money and the earnings are sheltered from taxes. The money is only taxed at withdrawal, similar to a conventional IRA. This is actually better than a conventional or a Roth IRA because the contribution limits are much higher. Depending on your situation, it could be used to manage what tax bracket you're taxed at. Putting money that would have been taxed at a higher tax bracket now will save you those taxes now. And depending on how you take that money out during your retirement years, you'll be in a lower tax bracket than when you originally earned that money. During the years you have home runs financially, you can jumpstart your retirement and save on taxes. Now, it's easy to set up and operate. There's low administrative costs. There's flexible annual contributions, which is good if cash flow is an issue. But the employer must contribute equally for all eligible employees, and it's employer contributions only. So if you have employees, you have to contribute for each of them as well. But if you're solo, you can max out your retirement savings and tax savings with ease. Number two is savings incentive match for employees, a simple IRA. This option is similar to a SEP IRA, but requires that you match any contributions made by your employees up to 3% or a fixed non elective contribution of 2% of compensation. Matching rules are complicated, so investigate them. The maximum contribution limit is 16,000. Catch-up contribution limit for those age 50 and older is 19,500. By the way, if you'd like to see more tax content like this, hit the like and comment down below. Number three, individual 401k. This is also referred to as a solo 401k. This is very similar to a traditional IRA, but it's only for sole proprietors. That means you aren't allowed to have any employees except your spouse. Contributions are tax exempt. Taxes are only paid when the money is withdrawn. This is a great way to save a lot of money for retirement. With an individual 401k, you can contribute money as both the employer and the employee. The limits are 23,000, 30,500 if you're over 50 years old, and an additional 25% of income as an employer. The total contributions cannot exceed 69,000 or 76,500 if over 50 years old. As explained in the last video, with a spouse on payroll, it could double those amounts. You can begin withdrawing the money at age 59 and a half. If you take an early withdrawal, there's a 10% penalty. However, there's some exceptions. Money can be withdrawn early without penalty for several reasons. These reasons include purchasing a first home, paying for higher education, sudden disability, and the prevention of foreclosure or eviction. There are some newer reasons such as personal or family emergencies up to $1,000 per year, and domestic abuse, the lesser of $10,000 or 50% of the account, penalty free, and can allow for the participant to self-certify that the incident occurred. Additionally, under certain circumstances, the individual could repay the amount taken for the following 3-year period and receive a refund for income taxes on the amount repaid. Now, the next big one is for all 401ks, employer matching student loan payments. So your student loan payments could count for elective retirement contributions, so the employer can match your payment and add to your retirement savings while paying down student loan debt. Share this with anyone you know, even if they're not a business owner with student loans. So if you run your own business and have student loans, you could go and contribute to your retirement while paying down your student loans. Number four is a Roth individual 401k. This is simply the Roth version of an individual 401k. So you'd have to contribute after tax money. However, no taxes due when the money is withdrawn. It saves you taxes on money. You take it out in your retirement years, which hopefully you grew a sizable nest egg. Under the new Secure 2.0 Act, there are no required minimum distributions. So you aren't forced to take distributions in your early 70s anymore. Now, all of these have higher contribution limits than a traditional IRA or a Roth IRA and allow for you to get potentially huge deductions for your business while building for retirement. Watch out for common pitfalls: waiting too long to save, underestimating retirement spending, or over-relying on Social Security could throw a wrench in your plans. You never know what the future holds and how long you'll actually be working. Also, you may be spending more than you think in your retirement ages. So make sure you store up that war chest to be full when the war is over. Another pitfall is underestimating healthcare costs. It's very typical for retirees to have healthcare expenses that can run $250,000 and beyond what Medicare covers. Remember, Medicare doesn't cover dental, vision, or hearing issues. Most retirees underestimate healthcare costs. So be realistic in your assumptions. That brings me to the secret retirement account that's a triple threat. It's a health savings account, an HSA. Most other retirement accounts were not taxed on money contributed, not taxed on money that grew. When you withdrew it, it was taxed on the money taken out. Or with the Roth, it was taxed on the way in, it grew tax free, and it's withdrawn tax free. An HSA is tax free on the contribution, grows tax free, and is taken out for medical expenses tax free. Let me know in the comments if you'd like me to break down an HSA in more details and how it could be a tax saving strategy. One of the best things any business owner can do is get expert advice regarding retirement and regarding taxes. If you tax plan, it's possible to maximize your tax savings. It's often said that a business owner making $50,000 could live like they make $75,000. Life for the self-employed tends to be busier, more hectic. It's easy to fall into the trap of putting off saving for retirement. Your income might fluctuate. Those high earning years, they're golden opportunities to boost your savings way beyond what traditional employment allows. It's all about making the most of what you got. With a bit of knowledge and a proactive approach, you can turn self-employment into a retirement planning advantage. That's why JDB Tax Strategy helps business owners legally save money on taxes without fear of the IRS by leveraging the tax code to the fullest extent. After booking a consultation call with us at jdbtax.com, we'll build a personalized battle plan to minimize your tax burden and maximize your wealth. So subscribe, hit that notification bell, click all to join me on this epic quest to conquer taxes and claim your financial throne. I post tax tactics every Tuesday and Thursday. See you next time, Tax Warriors.